If you've got some gold, please let us know. We'll give you dollars. If you've got any silver, let us know. We'll give you dollars. Banks don't want to have, they don't want to encumber their balance sheets with gold, physical gold or anything like that. This is a very dangerous situation, Andy. If I was in Putin's shoes, also I would accelerate the collapse of the fiat currency system. The ruble and also the yuan could go on to gold standards tomorrow. This, to me, is a pretty powerful signal, particularly given that the banks have been told to get rid of their US Treasuries. Typically, you find there's something like 800 trillion of derivatives outstanding, according to the Bank of International Settlements. The artificial supply of paper gold, paper silver, diminishes, which creates a greater squeeze. And I think this is probably what we're seeing. I mean, you see the drop in open interest now on COMEX. It's actually, it's no longer a question of increasing your wealth. Forget that. It's a question of protecting your wealth. And there's only one answer: get the hell out of credit. The first thing they did was they started dumping dollars for everything they could. You know, any gold, if you got some gold, please let us know. We'll give you dollars. If you got any silver, let us know. We'll give you dollars. Copper, we'll give you dollars. Oh, and by the way, we're going to hang on to our sulfuric acid. And we're going to hang on to our fertilizers because we don't want any dollars. And amazingly, in spite of all the sort of toing and froing over tariffs and all the rest of it, the trade surplus is standing at a record. More damn dollars. We don't want the stuff. So they're trying to get rid of dollars. Now, they can see what's going to happen to the purchasing power of the dollar. They've known this for a long time. And indeed, you go back to April the 2nd, which was Trump's Liberation Day. The following week, President Xi did a whistle-stop tour around Southeast Asia, following which suddenly we found that there were plans to open for the SGE, no less, which is a purely domestic operation, to go and open vaults in Hong Kong and also in Saudi Arabia. Why? Because there were two sort of areas. I mean, Hong Kong was, if you like, the international center for China. Saudi Arabia, well, they buy a lot of oil in that part of the world, etc., and they could see what was going to happen to the dollar.
China kept accepting dollars while simultaneously expanding gold infrastructure. And that contradiction deserves far more attention than tariff headlines. Alasdair Macleod notes, these vault expansions followed immediately after April's geopolitical shifts, hinting that settlement strategy mattered more than public diplomacy. Institutions prepare for currency transitions years before investors recognize them. Savers relying only on official narratives risk reacting after purchasing power has already eroded. Next, Alasdair Macleod reveals why China's gold logistics matter more than its public reserve figures.
And therefore, I mean, I tell you, actually, just diverting just a little bit. Back in 2014, I interviewed a director of a major Swiss refinery, and he was telling me they were working 24 hours a day, 7 days a week. And one of the things they were doing was they were shipping in LBMA 400-ounce bars in Arab ownership, recasting them into Chinese standard 4/9, 1 kilos, and then shipping them back to the owners. Arabs. For goodness sake, they could see back in 2014 which way things were going. So the idea that this is suddenly a surprise, I mean, no, it's not a surprise at all. The real money knew that this was basically going to happen at the end of the day. But I mean, whether it was going to be a violent transition or whatever, who knew? But anyway, China basically knew right from the outset, back in 1983, when they appointed the People's Bank of China as sole agent for the state in managing gold and silver resources, buying, selling, whatever, alongside its foreign exchange duties. They knew that they needed to accumulate gold and silver against the day when fiat currencies failed. I mean, we're going back 43 years now, because that's when that legislation came in. I mean, I've got copies of it in English. So they've accumulated a lot of gold and silver off balance sheet, let's put it that way, rather than on, as part of PBOC's reserves.
The timeline matters because major monetary transitions are usually visible years before headlines admit they exist. According to Alasdair Macleod, refiners were already reshaping Western bullion into Chinese standards back in 2014, revealing institutional expectations long before today's debate. Smart capital often signals tomorrow's monetary order through logistics rather than speeches. Investors ignoring these patterns risk mistaking preparation for coincidence. Next, Alasdair Macleod exposes why China's hidden gold accumulation challenges official reserve statistics.
They got stacks of gold. And, the people who were only permitted to buy gold from 2002 when the SGE was open, they've taken delivery of some 28,000 tons. Now, admittedly, some of that's gone back in scrap, but it hasn't left the country. No gold was allowed to leave the country. If you wanted to take gold out, you had to get the permission of the People's Bank, which basically wasn't forthcoming, and of course the customs officials. 2 weeks ago, they turned round and said, you no longer need to seek our permission to export gold. Obviously, it's now just a customs matter. And of course, this opens up the link between the SGE and the new clearing and settlement system in Hong Kong. And furthermore, they have appointed refineries in Shenzhen to specifically recast gold for this new operation. It's all part of what eventually will be the monetization of gold, in the sense that the yuan will take over, if you like, as the settlement currency for gold transactions. Because if you look at what we're doing in the West, gold contracts, whether it's a futures contract or whether it's a forward contract, it's not really a contract in gold. It's a contract in dollars. It's paper. And if the dollar's valueless, you don't have a market. And that's what they see. So they are setting up, if you like, the market which will take over from us. And already, they've taken most of the world's gold over there. The market's now going to follow.
Gold rarely leaves China, yet policymakers just relaxed export controls precisely as new settlement infrastructure comes online. What Alasdair Macleod is highlighting is that this looks less like liberalization and more like preparation for a larger monetary role. Western paper markets still price gold through dollars, creating a vulnerability few acknowledge. Investors should ask which system survives if confidence in fiat weakens. Next, Alasdair Macleod unravels why Russia and China may already be positioned for that shift.
This is a very dangerous situation, Andy. And I think that it's now, just to add a little bit of guilt on this one, as it were, G-I-L-T rather than G-U-I-L-T. I think that if I was in Putin's shoes, I would accelerate. I would accelerate the collapse of the fiat currency system. Because, both the ruble and also the yuan could go on to gold standards tomorrow. That I have absolutely no doubt. You look at the economies, you look at the situation, you look at the gold reserves. Russia, as well as what they've got on the balance sheet of the central bank, they've got sovereign wealth funds with extra gold. Both nations are major gold mining nations. They could go on to gold standard tomorrow. What's actually going on in Hong Kong? Then basically they're ready to watch the West collapse and maybe give it a little bit of a nudge. And I think this is actually what China's doing. It's interesting. Back in February, it emerged that China had told its banks to lighten its load, if you like, of US Treasuries, which actually, put less diplomatic, was sell the damn stuff, get out. And then we have another thing, which was fascinating. You had the Chinese banks, obviously under instruction from the SGE, from the People's Bank, if you like, which owns the SGE and runs it on behalf of the Communist Party. Close all your speculative positions.
Treasuries remain the world's safest asset, only as long as major creditors continue believing that story. Alasdair Macleod's argument suggests China's reported reduction in Treasury exposure could matter far more than another quarter-point rate decision. Markets obsess over central bank speeches, while sovereign positioning quietly changes underneath them. Long-term wealth preservation depends on recognizing those shifts before they become consensus. Next, Alasdair Macleod reveals why China's banks suddenly changed their trading behavior.
By the 24th of July. I mean, I don't know what the significance of the 24th of July. I guess it's something to do with the expiry of the SHFE current contract, I guess. But why close your positions? Well, the answer, quite simply, is that rather like in the West, you find that people are net long. The speculators are always net long, which means that the establishment is net short. So the establishment is saying, close your positions. That way, they are no longer net short. Boom, that's it. I mean, wouldn't it be wonderful if you're a swap on COMEX, you just turn around and tell everybody, close your positions?
Yeah.
Yeah. So they know something's coming along. And I think that, I think it would be a bit of a stretch at this stage to say that just at some time, let's say in the week or two after the 24th of July, the government is going to turn around and fix the yuan gold exchange rate. But I think I would rather take the view that the Chinese authorities are exceptionally well informed about what is going on in the world of finance generally. And they have probably taken a view as to what is likely to happen to the gold price, which is why at the same time you had the banks were, if you like, encouraging savers to buy, to invest in their gold accumulation accounts.
Yeah.
So, proper investment, do away with the speculation.
When governments discourage speculation while encouraging household gold ownership, investors should pay attention instead of dismissing it as routine policy. This is where Alasdair Macleod's thesis shifts from market mechanics towards strategic preparation. Institutions appear focused on reducing financial exposure while directing savers into tangible assets. That's a very different message than the optimism dominating financial television. Next, Alasdair Macleod exposes why price weakness may actually conceal official intervention.
So this, to me, is a pretty powerful signal, particularly given that the banks have been told to get rid of their US Treasuries. It's just an amazing situation.
It is amazing, and I think we're talking about this situation where China shuts down the speculative interest and forces accounts to close. Now, it's been misread because clearly when you do that, well, obviously you're going to see that's why Shanghai's been trading at a discount to the fixed price. But the strange thing is, Alasdair, and obviously we're, as you are, we're very close to where these 400-ounce bars start moving at the fixes. It's really strange. But while the SGE has been trading for the last 3 weeks at a discount, at the fixes, it doesn't. It pops back to a price and then it goes back into a discount. So what more, how much more evidence do you need? That's PBOC footprints all over this, and maybe Russian footprints all over it too. I don't know, but certainly that's what that is being misread by the mainstream media and everyone else. Oh, look, it's gold and silver. Look how weak they are. They're on a decline. And it's incentivized. This is the irony. The shorts, the speculative shorts, to load up again, probably 100 to 1. God knows what rate they're loading up at. I mean, there reaches an inflection point where this whole thing just literally implodes in their faces.
Headline weakness can hide institutional accumulation when official players influence market structure behind the scenes. Alasdair Macleod notes that repeated pricing behavior around the daily fixes deserves closer attention than temporary discounts. Retail investors often chase price, while institutions monitor settlement flows and physical movement. The difference explains why public narratives frequently lag professional positioning. Next, Alasdair Macleod reveals the structural flaw inside paper bullion markets that few investors recognize.
Yeah, it does. I mean, it's interesting because the whole point about both the futures market and also the forward market in London is they're paper markets, and they're paper markets. Why? Because the banks take part. I mean, banks don't want to have they don't want to encumber their balance sheets with gold, physical gold or anything like that. They want to trade it for basis points, and that's what they do, and they do it in huge quantities. It's exactly what they're doing with the whole of the derivatives situation. I mean, this is why, derivatives, I haven't looked at it recently, but I mean, typically you find there's something like 800 trillion of derivatives outstanding according to the Bank of International Settlements. And that's probably 80% of it or something like that. So, it's a sort of quadrillion of derivatives. Where is the capital backing this? It's not really there. It's basically pass the parcel with great rapidity, if you like, and that's why you're seeing these sort of huge great numbers, and numbers which really I think shocked the investment world when it first became clear what the turnover I think back in the 90s was on the LBMA. I mean, what really? Yeah, I mean, the value of the turnover is just, I mean, in those days, $1 billion was, a serious amount of money. Now, of course, it's sort of getting in the way of small change. But
derivative markets have expanded far faster than the real assets supposedly supporting them, and history rarely rewards that imbalance forever. According to Alasdair Macleod, paper bullion exists because banks prefer credit exposure over physical ownership. That model functions only while confidence remains intact and counterparties continue performing. Investors should remember that liquidity often disappears precisely when it's needed most. Next, Alasdair Macleod exposes why shrinking paper supply could transform precious metals pricing.
This is actually the way the whole thing has evolved. It's because of banks. Banks, if you like, dealing in credit. Now, the moment that the credit bit, if you like, becomes unprofitable, then you can forget it. Now, what that means is that the artificial supply of paper gold, paper silver diminishes, which creates a greater squeeze. And I think this is probably what we're seeing. I mean, you see the drop in open interest now on COMEX was actually, when it first started really dropping, the price of gold and silver was rising and rising and rising. It's continued to drop, I think, basically as the establishment tries to get out. I mean, I was looking at the average swap position on silver, when the price was up above 100, and you were looking at something like the average swap position was short $3 billion or something. Now that's dropped to under $1 billion now. So, that tells you roughly why it is that the price has dropped, because people have wanted, the establishment basically wants out. And it explains, if you like, also why it is that, it's dropped at a time when the demand for physical silver and physical gold has been flowing, in great numbers out of Western capital markets into China and elsewhere in Asia.
Falling prices usually suggest weak demand, yet physical metal keeps flowing east while paper exposure contracts. What Alasdair Macleod is highlighting is a contradiction mainstream analysis rarely addresses. If institutions are reducing short exposure as physical demand strengthens, the market may be signaling transition rather than weakness. Wealth preservation means following capital flows instead of headlines. Next, Alasdair Macleod unravels why abandoning credit may become the defining investment decision.
It's no longer a question of increasing your wealth. Forget that. It's a question of protecting your wealth. And there's only one answer: get the hell out of credit. And for the avoidance of doubt, currencies are credit. And we know that because if you look at the balance sheet of the issuer, central banks, it appears as such as a liability of the central bank. A liability, or the other side of credit. It's all credit. It all depends on the valuation which creditors put on the stuff, and we can see why that valuation is going to collapse. Get out of credit, get into physical money, which legally from Roman times has only been gold and, with a subsidiary role nowadays, silver. Simple.
Protecting purchasing power becomes far more important than chasing returns when confidence in financial promises starts weakening. Alasdair Macleod's argument suggests investors should distinguish between assets backed by counterparties and assets held outright. That's an uncomfortable conversation because modern portfolios depend heavily on credit-based instruments. History repeatedly shows confidence can vanish much faster than expected.